Exit tax when renouncing your U.S. citizenship or green card. These are some strategies to optimize for exit tax in your situation if you want to renounce. I'm Vincenzo Villamena, CPA and founder of Global Expat Advisors, and we've helped hundreds of people renounce their U.S. citizenship and optimize in this situation. The first question on exit tax is, what is an exit tax? An exit tax is a hypothetical sale of all of your assets on the day before you renounce. This could be investments, such as non-liquid investments, like if you have investment in private equity fund, etc. Any other sort of real estate or other companies, again, that aren't liquid, and then of course brokerage accounts, right? So stocks, bonds, etc. All these assets are hypothetically sold as of the day of your renunciation. So you have to value all the non-liquid assets, all the real estate, and then of course you get the value of the stocks at the closing the day before you renounce. Let's take an example of a client. This client had a net worth of $3 million, which means that they were a covered expatriate, which means that they were subject to the exit tax. This net worth consisted of $500,000 in cash, $1 million in stock, and $1.5 million in real estate. Let's look at what a hypothetical sale of these assets would look like. So you have the cash, which is worth $500,000, and of course would not have any capital gain or loss. Now you look at the stock, which is worth $1 million, but the basis was $250,000, which means there is a $750,000 capital gain. And then you also have the real estate, which is worth $1.5 million, and it had a $1 million basis, which means there is a $500,000 capital gain. So in this scenario, there's $1.25 million capital gain, and then there is an $821,000 capital gain exemption that is given to people that expatriate. Then you have a net capital gain of $429,000, which at 23.8% is roughly $102,000. That will be the hypothetical exit tax in this scenario. Now, of course, the thing is, this could have all been optimized. And there are a few ways that could have been done. Okay, first is to just try to avoid being a covered expat. So let's look at how one would qualify to be a covered expat. All right, the first thing is you're out of tax compliance. Okay, you haven't filed in years. This is a very easy fix because you just have to get into tax compliance for the last 5 years. Now, right now, there is a very straightforward amnesty program called the IRS Streamline Program. So you apply for the Streamline Program, you submit your last 5 years of tax returns, last 6 years of FBARs for foreign bank account reporting, and boom, you are in compliance. So you do not have to be a covered expat for being out of compliance. Next, you are considered a high-income expat. What that means is you owed an average of $190,000 in taxes over the last 5 years, which is a lot. So that means that at the time of renouncement, this average has to be under that amount. So of course, you have to wait until your average is below that 190K amount. So there's different strategies to obviously optimize there, whether it's charitable deductions, so on and so forth. So again, getting under that 190K average would mean that. And next is high net worth expat. These are people where their net worth is above $2 million. And so what is the best way to optimize there? Is gifting. Gifting could be to an actual trust, or it can be to your spouse or your kids. If you strategically gift to people, you could reduce your net worth to under $2 million in order to not qualify as a covered expat. And by not qualifying as a covered expat means that you would not have to even do the exit tax calculation. Now, it's really important to note that you cannot gift the same year as your renunciation, or it will be considered as part of your net worth. And really, if you want to play on the safe side, you should actually gift several years before your renunciation, just to avoid any type of risk of the IRS clawing back on those gifts that were made. Now, many people know there is a lifetime gifting exemption of $12 million. So again, you have up to $12 million that you can gift throughout your lifetime. So the strategy, of course, is to gift that $12 million up until you get under the $2 million mark. So in reality, people get roughly $14 million where they can have that net worth and not be considered a couple expat. In the case of couples, you have a limited gifting between both couples. And so you could do something where you gift one to the other and then one renounces. And then even later, if you want, you could sponsor your spouse for a green card. So again, there are a lot of ways to play this game and optimize here depending on your tax situation. And finally, how to optimize for the exit tax. As I explained previously, there is a capital gains exemption on the exit tax of $866,000 in 2024. So as long as this hypothetical sale of assets the day before your renunciation has a capital gains of less than 866, then you're in a position where you do not have to pay an exit tax, which is even more important to strategically gift assets that have a very high built-in unrealized capital gains. So the assets with a lower unrealized capital gains, you can fall under this $866,000 exception. One other thing to note is that IRAs, Roth IRAs, 529 plans, HSAs, all will potentially have a deemed distribution the day before the renunciation, which means that these will all be taxed at ordinary income and you can't gift them. So again, there are a lot of strategies here when it comes to renouncing, especially if you're a covered expat. So it's very important to plan ahead, gift ahead, and know exactly what you're doing before you go to the embassy or consulate and give up your U.S. citizenship. I'm Vincenzo Villamena with Global Expat Advisors. Book a consultation with us. We'll be happy to help you with all this planning. Thank you.